Hi everyone, I am Punya Aggarwal, ACC affiliate, AA and AAA mentor at Being ACCA. In this video, this is a series of videos that I'm bringing for all my AA students who are appearing for the next attempt. And in these videos, I will be discussing and explaining to you some of the very important terms and topics that we will be encountering in our AA syllabus. So this video can be watched any point in time, whether you are just starting with your preparation, whether you are, your preparations are ongoing, or you want to do a revision. So these videos, these set of videos will be having, these will be a series of videos, and in each video I will be explaining you 10 top 10 and or 15 top important topics or phrases or words which are very common in audit and you should know for a good base. So I will be linking the playlist also for this video down below. Let me know if this video was really helpful for you so that I can come up with other videos as well. This is a PDF that I'm making by myself, which is including all the important terms and terms and words and topics of our double A syllabus. So you can reach us out on our Instagram page to get to know more about this PDF, or because this PDF is exclusively available for my test series students. So yeah, let's begin. The first thing that we have is a very common word which is also a part of our course name, which is audit and assurance. Assurance, the first word that we have over here is assurance, and a lot of students actually think that audit and assurance are same, or but it is not actually true. If you read the name also, they have put and, they have not put a comma, right? So if we go about with that, then our assurance is very different from audit, right? Assurance is actually like an umbrella term. So basically you have assurance as a head thing, and then under assurance you have different services that an auditor can give, and audit is just a part of it. Okay, so if we go here, it is an independent professional service. So again, we know that assurance is a professional service that an auditor gives to an organization, about which improves the quality of the information for the decision making. So here the information that they're talking about is the financial statements. So the auditor will actually see the financial statements and then tell that is it true, is it fair, is it correct, is it, does it have any mistakes, so that it's easier for the decision makers. Decision makers, who are the decision makers? Decision makers are the stakeholders of a company, not shareholders, stakeholders of a company. I hope that you know the difference between them. It is an umbrella term which consists of the following services. So there are other services also. I have laid down only four over here. So audit, which we just discussed. Then you have your business ethic audit, social responsibility reporting, environmental reporting. These all terminologies you'll eventually study in your audit syllabus also. What is environmental reporting? What is social responsibility reporting? As the name suggests, you talk about the social responsibility which the company is doing, or the environmental factors which the company is looking forward to. Then you have performance measurements. So all of these things are a part of your assurance. So another two to three terms which we eventually will be discussing in our forthcoming videos is your limited assurance, which and your reasonable assurance. So these two terminologies also I will be discussing in the near future, so stay tuned for that. Now again, here I have written some examples also, so that this is basically, this is some little bit of bookish knowledge if you say, and this is like my commonsensical, the easy knowledge, that easy language that we usually use in a day-to-day life. So you can read this and I think you'll be good to go. I've just explained the same which I just now explained. Now, next term is materiality. Very commonly used term in audit. You will find it everywhere, and you should know the basic meaning of materiality. I'll first explain this to you by using an example. I think then you'll be good to go with the definition of it also, right? So, supposingly there's a company A and then there's a company B. Okay. Now, the total turnover of company A, for example, is rupees 10,000 INR. Okay. I hope that you know the meaning of turnover. Turnover is nothing but your total revenue that the company earns in a year. Annual turnover, basically. Annual revenue, basically. Okay. So we have 10,000 INR as revenue of this company. So revenue is 10,000. And if the company B, the revenue is supposedly 1,000 INR only. Okay. Now both the companies are looking forward to purchase an asset. Okay, so they want to purchase an asset. Now the cost of that asset is rupees 500 INR. Okay. Now 500 for this company, and cost will be remaining the same for this company also. So we have 500 INR. So if you see, for them, they have a revenue of 10,000 rupees, and out of 10,000, they can easily spend 500 rupees. It's nothing for them, right? If we take out the percentage, it's nothing for them, the company A. But for company B, because their annual turnover is only 1,000 rupees and the cost is 500, it is 50%. Right. So for this company, company B, it is highly material. Material, basically, if I talk about very in very layman language, is important. This 500 rupees is very, very important for this company because they eventually have a turnover of 1,000 rupees only. But for this company, this amount is not very material. It is immaterial, close to immaterial, because for them, they have a revenue of um, 10,000 rupees, which is, it is lesser than 20%, which they're spending upon this, right? So here, materiality basically means something, some transaction which is important for a particular company, which can actually impact their financial statements. Now let's take an example here. They had 10,000 revenue, 500 rupees this cost. Now there was one more cost, which was, for example, 5,000 rupees. Okay. Now cost number two is 5,000 rupees for this company. Now materiality says an item of the financial statement can be material either individually, so we can see that it is not individually material, but then it can also be material in aggregate. Aggregate means that we have 4 to 5 costs, and if we total them, then we get a figure which is material. So now here, 5,000 plus 500 rupees gives 5,500, which is material to 10,000, of course. Right. So materiality basically means some items of the financial statements which is important for the company and can impact their financial statements to a great extent. Okay. So if we read the definition, a very commonly used term in audit, materiality means an information is material if its omission or misstatement can influence the decision of the primary user. So now here, this decision, this 5,000 rupees obviously will be influencing my decision whether to go for the company or no, because ultimately, if I'm an investor, okay, now the company has a turnover of 10,000. They are making a cost, they are making a purchase of rupees 5,500, and they'll only be left with 4,500 as their profit. So as an investor, I will be seeing that if a company has good profits or no, right? So that is the influential part of it. It basically means an important figure or situation in company that can have positive or negative impact. Now materiality can be of two types. One is by the amount, so we just discussed about the amount, and one can be by the nature. So nature is basically, for example, if you are aware of IS 24, which is related party transactions, something which is happening in the company, not about the amount but about the situation. So here in the nature, we talk about the situation that can also be material. So this you'll be learning in more detail once you move forward, but this was the basic. This I've given the example also over here, the same example which I just now discussed. Then let's move ahead with the next topic, which is performance materiality. We'll be discussing in the next video. Then we have professional skepticism. Okay, now professional skepticism is also very, very important terminology. It is more so important for my triple A students also, but of course we have this terminology in our double A syllabus as well. So professionally, skepticism means, if you go by the English word, skepticism means critical, critically seeing some things. I'm being skeptic. I am being dicey. If you say, okay, let's use the word dicey. I am not sure whether, for example, let's first understand the English meaning. For example, I have choice number one and choice number two. I'm not able to choose which choice to go forward with. So I'm being skeptic, which is correct. right? So similarly in audit, okay, let's take one more example. There's a tutor. Okay, now the tutor is checking the answer scripts of a student. So now, of course, this tutor will be taking out mistakes or the errors which the student has done in the script. Similarly, treat tutor as an auditor, treat student as my client or the company, treat this mark sheet as the financial statement. So now the when the auditor is auditing any financial statements, he or she will be very very careful and vigilant, if I would say vigilant or in of the financial statement items of the financial statements, to see if there are any mistakes or errors in the financial statement. So that what professional skepticism means, questioning meant they will question every statement, every item of the financial statement, that why this has been done, why this was done, why this was not being done. So this was a questioning mind, being alert to conditions which may indicate possible misstatement, errors, mistakes, whatever. It basically means that auditors being very critical and eager to find the mistakes in the financial statement. So this is the same example which I just explained. Then the next topic, I'm sorry, the next topic that we have is corporate governance. Again, a very, very, very important term that we have is corporate governance. Corporate governance basically means that, how, it is a basically system. Okay. So how a company, a business organization is being directed and controlled. So basically, if you are working in any big fours, you would know big four or any other firm for that matter, you would know that, for example, we have at the lowest level we have a staff. Okay, so we have staff, then above them we have some seniors. I'm talking about the positions, okay, the hierarchy which is being followed. Then we have managers. Okay, then we have senior managers, and then we have directors. Okay, and then we have partners, and then we have CEOs. CEO, sorry. Okay. Now this is the person who is at the lower level. These are the person who are above him or her. So now there is a proper hierarchy. This is a lower level. This is maybe the middle level, and the top level is the director level. Okay. So in our lower classes also we have learned about the lower level management, top level management, middle level management. Similarly is corporate governance. So if you read over here, corporate governance structure specifies the distribution of rights and responsibilities among different participants in the corporation. So basically, what will be done by staff, what will be the responsibility of the staff, what will be the responsibility of managers, what will be the responsibility of directors, and if they are following their rules and responsibilities very very carefully, and they're responsible for they're also accountable for the responsibilities, all of these members in the organization, then it is called as good corporate governance. Okay, even if there is one person who is not following his or her duty correctly in the manner of the organization, then that will be a problem for the entire organization. Okay, so this is what is meant by corporate governance. So it looks like a very heavy word, but it's not a very heavy word. It's just that you need to be very careful. You just need to understand that, if a person is doing a particular job correctly, their responsibilities and their duties really nicely in the hierarchy of the organization, then we are good to go. Okay, so this is what is meant by corporate governance. So now there are two participants which we will now be discussing, which are part of our corporate governance structure. One is TCWG and one is management. Okay, now TCWG, I know a lot of students again get confused. So this is those charged, I'll show over here, those charged with governance. This is the full form, firstly, of TCWG, and that those people who look at the strategic direction of the entity. Basically, the people who are at the top level management, basically the directors. Then we have the executive directors, non-executive directors, the partners. These are all the people who are actually the TCWG, and they basically see at the strategy, overall strategy of the company, how the organization will function, what is the budget of the organization, and these are not they are not involved in the day-to-day functioning. They just make a particular strategy for a particular year and then they vanish, the gayab ho jate hain, right? And then management comes into the picture. Managers, senior managers, staff, all of these people come into the picture, and then they, follow those strategies, follow those budgets, make their own strategies, make their own budgets to follow these. Then they make the rules and regulations for the other people, and then they manage the day to day business of the organization. So those charged with governance is the highest level of authority that we have, and they do not look at the day-to-day functioning of the organization, whereas the management looks at the day-to-day functioning of the organization, right? So this is the major difference between your those charged with governance and management. You will see these words very, very commonly used in your entire audit paper. Okay. Now the next thing that we have is public interest entity. As the name suggests, an entity which is important, I would say, which is significant, which the public has a significant interest in due to any reason. It can be size, it can be nature, it can be the work that they do. Anything can be there, or an entity which due to which public has more interest, keen interest in the organization. That is known as your public interest entity. This word is not very commonly used, but then yeah, we do use it. Now, last two topics that we're going to discuss in this video is first is preconditions of an audit. This is a very, very commonly used, common question which comes as a knowledge based question also. So, preconditions of audit. So basically, when before an auditor starts with an audit of an organization, there are some conditions that are being met. Okay, so this is known as preconditions of an audit. So when management use an acceptable IFRS to prepare the financial statements, agree to premise on which the audit is conducted. Basically, on what, wait, let me just write it. Yeah, some of the relevant standards, IFRSs, which will be, on which the financial statements will be set, which is done by management. Then what will be the time of the audit, when the audit will be conducted, what will be the cost of the audit, what will be the structure of the audit, what will be the nature of the audit. All of these things, some of the things which we discuss before we start with the audit. Of course, we cannot directly jump onto the audit of a company, right? We need to do some background research about our organization. As an auditor, I need to know about a particular company. For example, if the company is in manufacturing, I need to know about the environment of manufacturing companies. So all of these things are part of your preconditions of an audit, and this is a very, very commonly tested knowledge based question. Okay, then the last topic that we're going to discuss in this particular video is our audit documentation. So basically, as the name suggests, audit documentation is a document which contains everything that the auditor has done during an audit. Okay, basically the preconditions that they do, the work that they did, the procedures that they followed, the risk that they identified, the controls that they looked forward to, the report that they made, the planning that they did, everything that they do during an audit, the proofs that they got, the sampling that they did. Okay, everything an auditor which the auditor does during the course of the audit, that is all documented in the audit documentation, which is a very, very, very important documentation. It consists of everything that the auditor will be doing during and before and even after the audit, right? So this is a very basic terminology which you should know. This basically comes in your section again. Sometimes they ask you what is audit documentation, and then give you like true false statements for the same. So that's the part of here. So I hope that this video was really helpful for you. We've covered 9 major, important topics which you should know. And I will be coming up with next part of this video very, very soon. Till then, let me know how was this video. Did you find it helpful? And yeah, thank you for watching.